Monetary and fiscal policy. Monetary and fiscal policy are two major forces that shape the economy and financial markets. Monetary policy is the central bank side of economic management. Institutions like the Federal Reserve, the European Central Bank, and the Bank of England use monetary policy to influence inflation, growth, and financial conditions. Their main tool is the interest rate. When central banks want to support the economy, they usually adopt expansionary monetary policy. That means lowering interest rates and making financial conditions easier. Borrowing becomes cheaper, spending and investment can rise, liquidity expands, and markets often find support. When central banks want to cool inflation or slow an overheating economy, they move toward contractionary monetary policy. That usually means raising interest rates, making borrowing more expensive, and tightening financial conditions. As liquidity contracts, spending and investment often slow, and markets can become more cautious. This is where the idea of liquidity expansion and contraction becomes important. Expansionary policy usually increases liquidity, meaning money flows more easily through the system. Contractionary policy does the opposite. It removes some of that ease, making money more expensive and financial conditions tighter. But markets do not wait for the full effects of policy to show up in the economy. They react to what they think is coming next. If traders believe a central bank is moving toward rate cuts, markets may adjust before any cut actually happens. That is because markets are forward-looking. They react not just to policy changes themselves, but to expectations, signals, and the likely path ahead. Now let's look at fiscal policy. Fiscal policy is the government side of economic management. Instead of using interest rates, governments influence the economy through spending, taxation, and borrowing. When governments want to support growth, they may adopt expansionary fiscal policy. That can include increasing public spending, cutting taxes, or introducing stimulus packages. These measures aim to put more money into the economy, support demand, and improve growth expectations. A common example would be after a recession. Governments may send stimulus payments like they did during the pandemic, launch infrastructure spending, or reduce taxes to encourage households and businesses to spend again. That can lift confidence and support recovery, but if demand rises too quickly, it can also increase inflation risk. When governments want to cool the economy or reduce deficits, they may use contractionary fiscal policy. That usually means cutting spending or raising taxes. These measures can help reduce inflationary pressure, but they can also slow growth.